Firstly, probably the economy. So, the government and the RBA is looking to reduce rates and have reduced rates, and they're doing that for a reason. Economy's faltering, unemployment's probably a little bit too high, productivity's down, and there's sluggish wage growth. So I think that's a factor for us in terms of how people make decisions around real estate, buying assets, refinancing assets, etc. So I think that's the first risk I'd be concerned about. We look at that carefully. We try to monitor it as best we can in making our decisions around advancing money in our business. The second risk would be around I'd say particularly around the residential market and around the time of the recovery. We're between cycles at the moment, and generally, that could be 18 months, 2 years, generally between a couple of cycles. And my concern would be that that length of time becomes too long, and the supply demand tips in favour of the supply, if you like, and the prices. Therefore, what I'm saying is that at that point in time, the demand is greater than the supply, and that causes a price issue in the market and an increase in rents, of course. So remembering markets, I see the market in residential particularly like a bathtub. At the moment, the market's come off and we're sort of tracking along the bottom of the bath, and it's just a matter of time as to when the market comes up the other side of the bath. So I think at the moment we're sort of going across the bath and we'll go back up, but I'm worried from a risk point of view that we're going the length of the bath and it's a longer journey along the bottom before we flip back up again. So that'd be my second one. I think the third risk I see is probably just around sentiment in the market. I think it's a big driver of our market, confidence of people to invest and own real estate and to be active in the market. And I want groups to be active in the market, buying, selling real estate and create activity. And the alternate lending market is providing finance to the market, and that in itself creates activity. Activity creates activity, and us supporting the market, if you like, is a good thing, and that helps sentiment in the market. So I think as long as our sentiment continues to improve, people have confidence to make investment decisions. I think generally the lower interest rates will help the commercial office markets as well. So I think people, seeing what cash rates are versus what they can get in investing in commercial real estate is attractive. So I think in this environment, people are prepared to accept a lower interest rate. So generally, that means they can bid a higher price for a property. Therefore, you generally see an increase in asset value during an interest rate cut period. So because of that ability of clients or borrowers to accept a lower return for the same sort of risk, if you like, in these markets. So I think that the interest rates cuts will flow through and take time for people to adjust to, but generally we see it as a positive for the real estate industry and for our business.